All right, everyone. Jon Machado here with the Machado Group. I thought I would take an opportunity, obviously, with the interest rate increase, seems to be the discussion on a lot of people's minds. And I figured, what better than to have a professional on with me today to discuss, obviously what this means to both buyers and sellers, but more importantly, maybe maybe put a little bit of our minds at ease and to dispel any of these myths that we might be hearing in the market, or maybe you're hearing from other people out there, or maybe it's even the news headlines. So today I would like to introduce Nelson Sousa. And Nelson, why don't you tell us a little bit about yourself, how you got into the business and how long you've been in the business?
Sure. Yeah. First, I'd thank you, John, for having me on today. I appreciate that. So, as John said, my name is Nelson Sousa. I'm a level two mortgage agent with Real Mortgage Associates. I've been a licensed mortgage agent for just over 2 years now. And my longer history really is entrepreneurial one, as well as real estate investing. So, real estate investing is something that I've been involved in for over 15 years. So really a background built of a lot of experience on the other end. I thought what a good fit for me. It's something that I really love to do. I also really like helping people. So I thought what a great fit for me to get into the mortgage game. And so that's what I've been doing for the last couple of years. And I've really, really enjoyed it, worked with some great people, and looking forward to the future of it as well.
Yeah, perfect. And I think, to touch on something that you had mentioned there, part of the reason that I got in this business is to help people. I had, done my own, buying and selling of homes and even flipping homes in the past. And I thought, what a really great experience it is, in terms of the real estate market. There's so many opportunities that are out there for everyone. And, kind of coming into the market, much like everybody else comes into this market as a first time buyer, kind of working hard to save up a down payment and come into it and then buy a house and develop some sweat equity and then inevitably move on to the next house and kind of keep moving that ball in that direction. Was why I essentially decided at one point. I said, I'm really good with people and I enjoy the process. Why not get into it and become a realtor? So for those of you joining that maybe have not seen anything that I've done before or know who I am, my name is Jon Machado. I run the Machado Group. I've been in the business for just over 10 years now, and I'm an agent with Remax. I run my own team and award-winning agent, Hall of Fame agent. I've collaboratively have done probably over 500 transactions in my career. So transactionally speaking, I've got quite a bit of experience and I've seen it all, both in residential and commercial real estate as well. So, but it's always been a pleasure for me to. I think the biggest takeaway for me in this business is helping people, and so when you said that, and and helping people, that spoke to me because that's what I really enjoy about it as well. So, anyways, enough with the introductions. I think everybody knows who we are now. Let's get into kind of the meat and potatoes as to this
Sure.
conversation. So, Nelson, tell us from your perspective, seeing the things, seeing the numbers, critically, right? This is what you do. You're working with people day in and day out, whether it's new mortgages or refinance or whatever the case may be. Your experience, what is your perception of where the market is right now?
So that's a really good question and really especially relevant for today's scenario that we find ourselves in right now. Like I said, it's been a couple of years since I've been a licensed broker. And when I got into the game, we were really at that peak, the height of just post-COVID. Prices had skyrocketed. We were still, what people think of decent, good interest rates, and people were just buying left, right, and center. And now I'm comparing that to today, and where I see people have a little more. They're a little more reserved. They're very much more cautious. And I think a lot of that has to do with the interest rate increases. But also, what I think most people don't realize is buying at a peak like that, like we saw 2 years ago, is really not as advantageous for you as if you were to buy, for example, that same type of property today. So yes, I understand that people can get nervous and I guess scared of a higher interest rate. But we know over like since the 90s, basically, the rates we're at today, 5.3% for a 5-year fixed, is historically not a bad interest rate. people being nervous and a little bit fearful of the market. And so the overall strategy, what you want to do is not purchase when the price of the property is high and rates a little lower. What you want to do is purchase when the pricing is lower. Because what we're seeing is people who paid that price that was, to be honest, a little high for what they were getting, and they got this great interest rate. But when it came time to renew, finding a lot of clients who are then finding themselves in a little bit of a jam, where contrarily, if you would have purchased, say today, when it comes time to refinance and the rates come back down, the value of the house goes up at the same time. Because in the end, it's purchasing a lot of what people make their decision on purchasing is what they can afford monthly. That makes sense, right? So when interest rates are a little higher, we see the house prices come down. When interest rates are a little lower, obviously the affordability goes up, so do the pricing of the houses.
Yeah, and that's a really interesting point. And I've had this conversation with a number of my own buyers where, when we were looking, let's say like a year or 2 years ago, when house pricing was really, really high. And I mean, like, even myself as a professional and doing this, day in and day out for the last 10 years. And I saw these prices. I mean, some would say, well, you would really benefit from that as a realtor because, it's no secret we're a commissions based service. So, our income is directly related to the cost of of homes. And albeit that might be the case, I mean, I was looking at this just as a consumer's perspective and saying, hey, this is really unattainable and it really doesn't make a lot of sense. Now, when we look into that a little bit deeper, we were seeing, and at least in my experience, homes, obviously, it was no secret. We had a lot of people that were a lot of agents, and this was the trend. I'm not singling realtors out here, but this was the trend. You priced a home below market value. You basically withheld offers for a certain amount of days. And then come a particular day, you would review those offers. What would happen is you would create this frenzy of showings, you would create this frenzy of interest, which then would have, maybe 20 or 30, maybe upwards of 50 to 100 people come through the home. And, maybe you would have 15 to 20 offers coming in on this property. Now, because of the competitiveness of that scenario, it forced buyers to really put themselves not only in a very uncomfortable position, but it really forced buyers to be as competitive as possible. So all of a sudden, logic goes out the window and emotion takes over. And what we were seeing is, because human nature, we're competitive, okay? We're all competitive. Buyers act on emotion, and buyers putting in bids on properties that were well above the market price and well above market value. So in some cases, it was necessity because they needed to overbid in order for them to win that home. But a lot of times, and in most cases, they were removing all of their conditions: no home inspection, no financing condition. So they were going into it with all sorts of risk. In addition to the risk, there was no guarantee that they were going to get that home or not. And so you also have another scenario where buyers had already lost on maybe two or three or four or maybe 10 properties prior. So when they came into this home, they had buyer exhaustion. They were just wanted to win at whatever cost possible. And they were just throwing in these Hail Mary offers. And these numbers that they were throwing in on these homes weren't indicative, nor were they, in line with what the market would suggest that house is worth. When we look at property, we look at the land and we look at the brick and mortar, there's an associated value to that. But you can't put a value on emotion. And so we had this emotional element, the competitive element that was being thrown into these homes. You have people paying far more than the home is technically worth. And, at that time we were like, well, what does it matter? Interest rates are low. The market looks like it's in this inevitable trajectory upwards. Who cares? You know what I mean? We'll be fine, right? And here we are, a year, 2 years later, the dust has kind of settled from this. And what we are seeing, to touch on your point, is we're seeing buyers that had purchased these homes, who had overpaid for these homes, that, albeit when they secured the mortgage on that home, they did so at a lower interest rate. However, inevitably, that interest rate is going to come up, or that mortgage is going to come up for renewal, and they're going to be subject to a different interest rate. And it's very likely that that interest rate is going to be higher. So now you've paid X amount of dollars for your home, at a high value, top of the market value. And yeah, you borrow the money at a lower rate than the market suggests now, but eventually you're going to have to renew. And when you renew, you're renewing at that high principal, right? And I think this is an element that people are forgetting. Whereas in the market now, we have home values have come down significantly. And you and I have we've got a little exercise that we're going to share with everyone.
Yeah, perfect. I'm going to do that in a second. I just want to follow up on what you were just saying about pressure everybody was feeling. After the housing crisis in 2008, um, we saw historically low interest rates for a historic long period of time. So in the mortgage world, we knew this was going to happen. We knew this was going to happen because you just can't sustain, offering a 2% interest rate for that long a period of time. It was over 10 years. It's about 12 years where we saw, excuse me, the interest rates ranging from in that 1.8 to around 3%. And I'll just say the average, we'll say from the 90s, it's probably more like 5, 6%. And so we knew the consequences of having that really low cost debt available to people for that long of a period of time, paired with the lack of inventory. So
Mhm.
just not building new properties as quickly as, in my opinion, as we could and we should. And those two combinations is kind of what led to where we were with the massively increased home prices. And again, like you were saying, that pressure that everybody was seeing, because we did see straight up of value of homes, the price of homes. And there was many times where people thought, oh, it's going to come back down. It's going to come back down. And it never did until it really did hard. Right. And now we're seeing the consequences. But I mean, yeah. And thanks for me including me in this. I did run the numbers on the comparable to if you were to buy last year at this time compared to if you were to buy today. Okay. So the West Brant single detached 3 bedroom, 2 bathroom home. Last year, average price 836,000, and you had a lower interest rate, 4.19% was the interest rate you could have got a year ago today. Amortized over 30 years, that monthly payment would be $4,070. Okay. Now remember that interest rate is 4.19%. Now today, you would be looking at 5.29%. That's 1.1% more than you would have paid last year. But as we discussed before, as the rates come up a little bit, typically we see the housing come down. And today you'd get that same house for only 705,000. Sure, you're going to pay the 5.29, but that makes your monthly payment only 38.90, so $3,890. What does that mean? That means it's an extra $2,000, over $2,000 that stays in your pocket every year, $180 a month. And most people are making their decisions, and reasonably so, on what their monthly affordability is. You want to buy a new car, a new house, whatever. Unless you have the cash to pay for it up front, what really matters is what can I afford monthly and remain with my lifestyle and be comfortable. Now, to go on from that, when these interest rates come down, we're likely going to see that $705,000 house climb back up closer to 8 and eventually even beyond. And that's where a real estate investor really makes their money. Because when the rates come down, the price goes back up. You only paid 705. Now we can refinance, we can add a HELOC, we can do a multitude of things to draw that equity out, and that is interest-free money. And that's where the real investor mindset comes in, to make the most of these times. This is a buyer's market. This is when people who can afford that monthly should be buying.
So basically, what you're telling me is that I would be
Mhm.
saving money. Now, I want to emphasize that in this particular example, okay, and I would say that the data, obviously, you can manipulate the data each way you did. What we did was we did a very simple formula here. We took, 5 homes, single detached in a popular subdivision in Brantford, narrowed it down, 3 bed, 2.5 bath, average price, and pretty simple, formula, pretty simple math here. I'm sure if you extrapolate the data, you can go one way or the other. But as a whole, this exercise really is I would say is pretty practical in today's, in today's figures. So what we're looking at is, albeit the interest rates are a little bit higher, but because the home sale price is lower, we are purchasing at a lower price. Sure, we're borrowing at a higher interest rate, but the principal is less. The other thing I want to touch on that, a lot of people haven't really looked at or really don't take into consideration is that if I were to buy a house today, and we know that down payments are a percentage of whatever the purchase price is. So if the average price is sitting at about 705 versus 800 and what was it, 36, I believe, 10%, let's just use 10%. If you had to come up with 10%, or if you were saving 10% as a down payment, 10% at last year's price would put you at 83, call it $84,000. At today's price, 10%, the exact same 10% is about $70,000. So that now
Exactly.
leaves us with an approximate, $14,000 savings that I can now either apply to my mortgage. I can apply that as an additional down payment, or I could take that money and be using it for my closing costs, moving fees, renos, whatever the case may be. And another point is that unless you have 20% or more to put down, you have to insure that mortgage. And if I understand this correctly, Nelson, if I'm insuring a mortgage, my insurance premium is based on the purchase price. Am I correct?
Yeah, exactly. So there is a set rate that you pay for the CMHC for your mortgage insurance. And obviously, if you're paying $100,000 less for the house or whatever that tag is going to be, then you're going to pay a lot less in the CMHC fee. You're going to pay a lot less, like you said, just to get into the mortgage. Now, full disclosure, yeah, sure, you're going to be paying a little bit more of your payment to interest. However, that the counterbalance of the lower down payment, the increase in equity over the next few years far outweighs the little bit of extra interest you're going to be paying. And again, remember, I always tell my clients, you look at your home as one big bank account, okay? And you want to open this bank account as soon as possible because we know property values, sure, sometimes they come down like we've just seen, but when you look at the macro, they're always going up. Um, it's supply and demand, and God's not making any more land, at least not here on earth for us. So there's only going to be so much to go around, right? Um, and the earlier you open that account, which is your home, your investment property, your mortgage, the payments you're making, the additional funds, like you said, that you're saving from the lower purchase price, that's going directly into principal. Sure, it's leaving your pocket, but it's going into your bank account. That is called
Right.
your new mortgage, your home, right? So it's not lost money. So again, now is the time to be looking at buying. There are other challenges. We're not in the greatest economy. Housing is, a little bit pricey, but still affordability wise, we're still seeing a lot of advantages to people who are in the market right now, as opposed to last year and the year before, as you were touched on earlier, the seller had all the power, all of the power. Right now, you have a lot of negotiating power as a buyer.
Yeah, I would agree with that. And that's another thing that I've shared with my buyers is that if we're buying right now, I recall a year ago, a little over a year ago, I would finish a showing, and the minute I walk out the door, I'm going to my buyers and I'm saying, guys, are we buying, or are we moving on? Like, what are we doing here? Because we got to submit offers in about 3 hours, right? And
Mhm.
that really doesn't lend to, coming up with what I would like to say, a very comfortable decision. When you're being forced and technically speaking, you're kind of under duress. It's a big decision, it's a big purchase, and you're being forced to decide right then and there without the opportunity of putting in a home inspection clause, without being able to put in a financing clause, to know whether the underwriters of the bank are going to approve that amount. Because I think a lot of buyers forget a pre-approval is a kind of a two-step process. You get an initial pre-approval that says, based on what we see, this is what you theoretically can afford. But then once you have an offer submitted into a property, you then submit that paperwork into yourself. For instance, I bring you the paperwork and say, Nelson, here's the house I just purchased. And then you submit it into the bank, and the underwriters have a look at it, and they still have to approve the value for that property.
Precisely, precisely. I would always suggest getting a pre-approval. That way you know exactly the budget you're working with. We did see a lot of that, John, where people were, like you said, feeling the pressure, almost forced into making a split decision. Um, and then once appraisal time came, at that time we were saying the pre-approval, still a great idea, but it might not be worth the paper it's written on,
Right.
because we were seeing houses come in 100,000 over asking, and I think even more than that sometimes. And like you said, the appraisers, the lenders were just looking at it saying, "I'm not quite sure. I'm not quite
Right.
sure that we're going to, agree with what you paid as the appropriate value." And what happens now, John, is the buyer has to come up with the difference.
Right.
So if you bought a house for any price, 700,000, and you're pre-approved for that loan, and the appraisal comes in and says, well, we only think the house is worth 650, you have to come up with that 50,000. And for
Yeah.
a lot of people that, I would say for most, that's not an easy hurdle to tackle.
Yeah.
Uh,
Especially at the 11th hour, right? I mean,
right,
like
yeah.
there's nothing worse than having to scramble for. I mean, it's one thing to scramble. I
Yeah.
think it's important to touch on that we did see a number of buyers in that same predicament where all of a sudden, at the 11th hour, they've got to come up with God knows how much money. And it's one thing like when somebody says, "Hey man, a few weeks, I need you to come up with, maybe like two, three, four, $5,000." I would say for a lot of people, we could probably lean on someone, go to like somewhere, get a loan, borrow it from, maybe mom and dad or whatever the case may be. But when you're in a scenario where you've got to literally come up with, 50, $60,000, maybe even $100,000, I mean, that's not necessarily something that can be dealt with very easily. So I know private lenders, specifically short-term lenders, were really benefiting from
Mhm.
that. Kind of to go to circle back to where the market is today and why it's better as a buyer is because right now buyers are really benefiting from, not only have we already been able to prove that you're technically, and in some cases, if not most cases, you're going to be saving money monthly on what you would say is a relative mortgage payment for the same home you might have purchased a little over a year ago. You're going to be saving money on your down payment, so you're going to be putting less money down. But the other thing is you're going to be able to purchase a home with that peace of mind and that ease of knowing that right now I see a lot of great properties. I'm in the market myself right now, actually. I'm looking for a home myself. My wife and I were shopping, we're looking. And, there are homes that we've gone to look at like over a month ago that are still on the market. So, I
Exactly.
mean, we've had the benefit of time to sleep on it, to think about it. And I think that that's, when we start looking at that, it's definitely a much better place to be than we were, let's say, a year and a half, year, 2 years ago. So we do have the benefit of time on our hands. We don't have to feel rushed to making a decision, especially a big one like purchasing a house. That's a pretty big decision. But
Probably
more
the biggest
so
decision people will ever make in their lives.
financially, for sure.
Absolutely.
And moreover, to touch on your point that you brought up, which is a really important point, is that when you purchase the house today at a lower purchase price, mortgage rates, and we anticipate mortgage rates aren't going to continue to rise. I mean, we might see it go up a little bit here and there. Who knows, we might see it go up another point, whatever the case may be. But the odds are, historically speaking, we're going to see interest rates eventually start to decline. And when we see the rates start to decline, I'd much rather be in a position where when my mortgage comes up for renewal, not only am I going to renew at a lower rate, but as those rates start to decline, my home value is going to continue to appreciate. So you have this twofold process where all of a sudden, not only has your home value gone up from the time you had purchased it, but now you're going to renew your mortgage at a lower rate. So effectively speaking, you've really created this really nice equity gap, really. You know what I mean?
Absolutely.
And that's kind of important. Whereas if we were to look at the same scenario a year ago or 2 years ago when everybody was buying at the top of the market, although you're borrowing the money at a lesser rate, you don't really have, now that we look at the market, you don't really have that equity in that home. When
Right.
we look at the example that we worked on, where there was like $130,000 difference in price points, within a year, $130,000. Now, can you imagine if you had purchased that home again, same scenario, you'd purchased that home a year ago, and your home has gone down by 130,000? Same home. Do most of you or most of us who had purchased that home have $130,000 in equity in that home?
Right.
You came into it with the minimum. we've already said, like, if you come into it with 10%, for example, a year ago, you came into it with 80 grand, right? You overpaid for the home. Now that home is essentially worth $130,000 less. All of a sudden now you're like, okay, well, how much equity do you really have in that home? Yeah, you really don't have any equity. If you only put, 10%,
Exactly.
you don't really have any equity. So you can't even really afford to move if you wanted to. So, I mean, that's kind of it's an interesting point. So, kind of to circle back, the whole reason for this topic is that, we want to talk about how it's important to educate yourself on the market. It's important to have these discussions with professionals and not rely on what, your coworker or your uncle who bought a home in 89 when things were crazy. Talk to professionals such as myself, such as a mortgage broker like Nelson. I mean, it's important to have these conversations, because if you just go based on what you hear in the media and in the headlines, and and again from coworkers and peers, you might not take advantage of this really good opportunity to buy into the market. Although it seems impossible, and maybe for some it might be, and I'm not saying it's not challenging. And I'm probably the last guy to talk to about that. I would say, if you're in a challenging situation, definitely speak with a mortgage broker. We encountered this with clients of mine who thought that they were maybe not in the best position to make a purchase, and I directed them to you, and you had a conversation with them, and they ended up finding out that they were actually in a much better position than they thought they were, because based on everything they're hearing around them, based on the media, based on headlines and what they're observing with their eyes, but not getting any sort of confirmation or research or information that goes over everything is critically. They thought they were in a bad spot. They thought that it was not even attainable for them, and
Yeah,
because
I mean,
prices have come down, it's really made it even more attainable for them.
yeah, absolutely. And I remember that couple very, very, very well. And that is exactly what happened. In fact, I think before the conversation, the initial communication with them was like, oh, we don't almost like, oh, we don't really want to waste your time. We know we're not there yet. And I said, well, okay, well, if we're not ready now, then at least let's start working together, and I can help you prepare for when that day comes, when the day is right for you. And lo and behold, like you just alluded to, yeah, they're perfectly fine and totally pre-approved within 24 hours. And now they're out there looking for a home. And just to backtrack really quickly, when we're talking about being a buyer's market now and the advantages of that, you know, people, and the reason why it's so important to work with a professional that you trust, because this is the time where investors make money. There's thousands of people who nobody wants a recession, nobody wants to see a loss of equity, but people who are in the know are waiting and salivating for this time, because this is where millionaires become multimillionaires.
Right.
This is where, not instantly, but over a couple of year period of time, because of that process, buying when the asset's low, refinancing when it grows, you take that money, which a lot of people might not realize. If you're pulling the money out of your equity, that is tax-free money, which you can
Right.
use in any way you decide. One of those ways is investing in more real estate. Like you said before, renovate your home. You can take a vacation, but that's tax-free money. So if you're in a status where you're continually doing that, the frequency depending on, your capabilities financially or otherwise, or desire even, that's a lot of tax-free income that's coming in. And that's how generational wealth is built, by following that cycle. And you might not hear that a lot on the news or in the media. Why? Because people in power are buying up all the properties, right?
So
They're not
it's so
telling you about
true.
it.
It's if they shared all their secrets, man, everybody would be wealthy,
Right?
right? So it's so
Yes,
easy to
exactly.
convince
So
everybody.
so you be scared. We're gonna go buy the real estate.
Yeah, exactly. Yeah.
Right?
Don't do
Yeah.
anything. Don't. It's a bad time.
Hey,
We'll
that's
go
right.
buy it up for you, right? So
That's
exactly.
right. Yeah.
All
Mhm.
right. Well, great. This is a really great conversation. Thanks so much, Nelson, for joining me today in this conversation. I think it's one that needed to be had, and I'm going to be posting this up on social, so it's free for anybody to have a watch here. And thank you so much again. And yeah, we'll continue these more often and
Yeah.
share some insight and info.
Yeah, I really appreciate it, John. That was really, really fun. And anytime you're up for it, so am I.
Thanks, man. All right.
Okay.
Have a good one.
Take care. Take care. Bye.